So you probably think profit is simple, right? It's just cash in minus cash out. But what if a company gets a huge check today for a service they'll provide over the next 3 years? Did they really earn all that money the second it hit their bank account? Well, it's actually way more complicated than you might think, and understanding why is the key to decoding the real story an income statement is telling you.
Okay, let's kick things off with a little thought experiment. Imagine a software company sells a 3-year subscription. The customer pays $3,600 all up front today. The question is, did that company just earn 3,600 bucks? The answer, surprisingly, is no. And understanding why is going to unlock this whole topic for you. And that whole problem, it really gets at the heart of two totally different ways of looking at profit. On one hand, you have cash accounting. It's simple. Cash comes in, you count it, but it can be super misleading. On the other hand, you have accrual accounting. This is the professional standard, the way all public companies do it. And it's built around one key idea. You record revenue not when you get the cash, but when you actually earn it. This gives a much, much truer picture of how a business is actually doing.
All right, so let's dig into that. When is money really earned? This is the big guiding principle behind accrual accounting. Let's go back to our software company. That 3,600 bucks, it doesn't count as revenue just yet. Nope. Instead, it gets put on the books as this thing called unearned revenue. You can think of it like a promise the company has to keep. It's a liability. Then, as the company delivers the software service, month by month, it gets to convert a piece of that promise, say $100 each month, into earned revenue. It's the same idea as a magazine subscription. You don't earn the whole year's fee up front. You earn it one magazine at a time. Okay, so you can probably imagine figuring out exactly when something is earned can get pretty messy, right? To stop every company from just making up its own rules, accountants have a universal playbook they all have to follow. Now, this might look a little intimidating, but it's actually super logical. First, you identify the contract. Easy enough. Then, you figure out all the individual promises you made to the customer. Accountants call these performance obligations. You figure out the total price. You split that price up among all your promises, and then, and this is the most important part, you only recognize the revenue as you actually deliver on each of those promises. It's a really disciplined system to keep everyone honest and consistent. Okay, so we've talked a lot about the money coming in, but that's only half the story, right? To get the real picture of profit, we've got to look at the money going out. This is the other side of the profit equation. And that brings us to this really core idea in accrual accounting, the matching principle. The idea is brilliant in its simplicity. You should record the expenses you use to generate revenue in the exact same period as that revenue. So if you sold a bunch of t-shirts in June, the cost of making those t-shirts also gets recorded in June. It creates a true apples-to-apples view of how profitable that month really was. But, not every cost is that simple. It's not always tied directly to a sale. This leads us to a huge judgment call for companies, a critical decision that can completely change how their financial story looks on paper. Should we expense this cost now or capitalize it for the future? So here's the big question they have to ask. Does the benefit from this cost get used up right away, or is it going to last for a while? Think about it like this. Your lunch. You get the benefit immediately, and then it's gone. That gets expensed now. It hits the income statement and reduces profit today. But what about building a whole new factory? That's going to provide benefits for years and years, so you capitalize it. It becomes an asset, and you spread the cost out over its life through something called depreciation. And check out the ripple effect of that one decision just in the first year. Look at this. If you choose to capitalize, your net income looks higher, your total assets look higher, even your cash flow from operations looks better. This is a big deal, and it's exactly why smart analysts really dig into these choices, because they can make a company look a whole lot healthier than it might actually be, at least in the short run. All right, so after navigating all those rules for revenue and expenses, we finally get to the famous bottom line, net income. But for an investor, the story doesn't stop there. We need to figure out what a single share of that profit is really worth. So, you'll see public companies talk about earnings per share, or EPS. But here's the thing you need to know. There are two versions. Basic EPS is just what it sounds like, total profit divided by the shares that exist right now. It's a simple, kind of optimistic view. But diluted EPS, that's the one the pros watch. It's like a worst-case scenario number that asks, what if all those employee stock options and convertible bonds suddenly became real shares? It's absolutely crucial for investors. So a company might proudly announce, hey, our basic EPS is $2.50. But then you dig a little deeper and you see the diluted EPS is actually $2.07. That drop, that's the potential dilution we were talking about. It shows you how much your slice of the profit pie could shrink if all those potential new shares were created. It is a vital reality check. Okay, we've gone through the rules of the game. Now I'm going to show you a super simple but incredibly powerful trick that analysts use to get X-ray vision to see the real story hiding in the numbers. All right, take a look at these two companies, North and South. North is a behemoth, pulling in $75 million in revenue. South Company is just a tiny fraction of that size. Just looking at the raw dollars, who looks like the winner here? I mean, based on these raw numbers, North Company seems like the clear winner, right? They're pulling in millions more in profit. But is that the whole story? Okay, now watch this. This is the magic. When we reframe everything as a percentage of revenue, what we call a common size view, the entire story flips on its head. Look, North Company has a 10% operating margin. That means for every dollar in sales, they keep just 10 cents as profit. But Little South Company, they have a 45% margin. They're keeping a massive 45 cents on the dollar. The smaller company is wildly more profitable on a relative basis. And that is why this matters so much. This one little trick cuts right through the noise of size. It lets you compare any two companies, no matter how big or small, on a true apples-to-apples basis. It helps you spot their different strategies and see the real underlying profitability that those big, flashy dollar signs can sometimes hide. So you see, an income statement isn't just a list of numbers, it's a story. And now that you know the rules, the grammar of that story, you can read between the lines. So the next time you see one, don't just look at the bottom line. Ask yourself, what story are these numbers really trying to tell me?